Hey guys, Steve Ferguson here, your modern mortgage loan advisor. Hope you're having an awesome day today. Today we're going to talk about something really interesting that you're definitely going to need to know, and that's the top 10 things that will absolutely obliterate and destroy your chances of getting a mortgage loan, which you do not want to do. Before we get into it, make sure you like or subscribe. Stay in tune with us. Message us for any videos you want to see. We're always excited about delivering great content for you guys and keeping you educated. So let's get started. Number one, now these are not in any specific numerical order. All 10 of these things are super important for you when you're going to get a mortgage loan. And the last thing I want to do is see you guys, think everything's going to go great and all of a sudden it all falls apart. So number one, ignoring your credit score. Listen, credit score is the number one factor, the very first thing that a lender will look at to determine whether or not you're going to qualify for a mortgage loan. So if you say, hey, you know what, I had some bad credit in the past and I'm not going to mess with it. I'm getting these collection mailer notices in the mail, or you know what, my doctor keeps sending me this bill and now it says it's in collections, but I'm going to ignore it because I heard that medical collections don't count. That's not true. So here's the deal. When you have bad credit, if you make a late payment, if you forget to make a payment, if you ignore those notices, all of those things are going to drive down your credit score. I'll give you an example. Now, keep in mind, these are generic numbers and generic information to give you a general idea. If you miss one car payment, if you're behind 30 days, now missing a car payment doesn't mean that your payment's due today and you made it tomorrow. That's still fine. But if it's 30 days before you make the payment, then that's called a 1 times 30 late, right? You've been late 30 days, one time. That can drop your credit score anywhere from 40 to 80 points, depending on what's going on in your credit. That's a huge difference. If a medical collection shows up on your credit report, that's like a credit card late. That'll drop your credit score between 20 and 40 points. So those things are all substantial items that can greatly impact your ability to purchase a home. So number one, pay attention to your credit, monitor your credit. Oh, by the way, let me drop this in your lap. If you're looking at online credit systems that are giving you credit scores like on your credit card statement or Credit Karma, et cetera, those are great tools to monitor things, but they are not accurate when it comes to score. Generally speaking, you can subtract about 30 points from whatever they're telling you, and that's probably closer to your real score. Things to know. All right. Number two, racking up new debt. All right, guys. You're wanting to buy a home, you're ready to get all this started, you're ready to rock and roll, and you're like, you know what? I love that TV. I'm going to buy that TV before I buy this home. Or, you know what? I want to get my furniture all set up, and I'm going to go ahead and get my furniture and apply for that credit and get everything bought, ready to go. So by the time I close on my new mortgage, I've got all this stuff set up. Well, guess what? You may have just set yourself up for failure when now you have all this furniture and no home to put it in. I've got horror stories over my decades of experience in the mortgage industry where people have decided to buy themselves a new car at closing, furniture. I get calls from people going to Best Buy. Steve, there's a great sale on this 100-inch TV for $10,000 I want. Guys, do not do anything like that. If you're going to buy a home, the goal is to keep your debt load low. Do not apply for any additional credit in any way, form, or fashion. Keep your credit card balances below a third of their limit. That's going to give you your best chance for success to make sure that your debt to income ratios are low. So, number two, do not go rack up any new debt. Do not apply for a card where you're co-signing for somebody. Don't co-sign for anybody during that time. Don't apply for new debt. All right. Number three, not saving money. Okay. Money is an important thing when you're doing a mortgage loan. There's programs out there that don't require a down payment, but there's still costs associated with getting a home. You have inspections, you have earnest money, you have option money, you have these things that you've got to have money for. So if you truly think or your goal is to truly get into a home with as little money down as possible, I get it. And I want you to be able to do that. And we're going to create solutions for you on that. But I still need you to save as much money as you possibly can. So put a separate account together. Say, you know what? I'm not going to touch this. This is my home buying account. I'm going to save as much money as I possibly can. And there's always strategies to get around some of these things. But if you don't have any money to put into the system, it makes it more difficult to get you into a home loan. Okay. So save some money, put it aside, stay away from that coffee, stay away from that fast food, eat at home for a minute, save that money. Okay. Number four, changing jobs frequently. Listen, I know that a lot of people out there are thinking, you know what, I just got offered a better job. It's more pay, or maybe I got a better job and they're paying me, straight up cash. Those things do not work for mortgage loans. Mortgage companies like to see consistency in job history because it means that you're a more reliable borrower. So there are certain industries where you see hopping around a lot, like some traveling nurses and stuff. There's different construction jobs where you'll see people move around doing the same job. We understand that, but if you've had more than probably 4 jobs in 2 years, it's going to be super difficult to explain why you keep hopping around. So you want to stay consistent in your job, especially if your goal is to buy a home. And that way it shows that consistency to the lender. Now, a couple things you don't want to do when you're getting a job: change the way you're paid. So if you're paid $25 an hour now, 40 hours a week, and you jump into this other job where you get $10 an hour, but you get bonus income, guess what? As a lender, I cannot use that bonus income on a traditional loan until you've had it for 2 years. And then they average that bonus income. So don't go do stuff like that. Talk to your lender, give me a call and say, hey man, I've got this great opportunity. I'll probably tell you, don't do it. And so let's get you to the home first. And then after you're in the home, you can do anything you want, but don't hop jobs. All right. Number 5, missing payments on existing debt. Okay. I run into customers sometimes where they're like, you know what, like this credit card payment, I totally forgot about the $25 minimum payment and I didn't make it. That can be a deal killer for you when buying a home loan, because it creates this aura around your mortgage loan that you're more likely to default on bigger items like a car or a house. And if you were going to give a total stranger $300,000 to buy their home with, and you notice that they didn't pay minor debt on time, how are you going to feel about giving them that money? Probably not very good. So that's the reason that banks look at these details, is they want to make sure that you're a good risk. And by you being a good risk, you get the best interest rates, the lowest down payment, etc. So it's really important not to miss any payments on anything. Even if you just have to make the minimum payment, do it. So if you're used to paying extra money per month, but you can't, it doesn't matter. Make what's due every single month on time. That's going to set you up for success when you're buying a home. All right. Number 6, making large purchases before closing. All right. Remember I hinted at this before and I said that person bought a car when they showed up to closing. Listen, when you're at the closing table, you're going to sign a document that states that you have not opened any additional credit during this process. And if you can't answer that that is true and correct, and you're like, well, you know what? I did show up in my brand new ride. Now we have a problem. I've literally had a client that did that, like I was telling you guys a few minutes ago. And I'm like, I hope you enjoy living in your new car, because you cannot buy a home now because that payment is too much money. Don't go buy a bunch of fancy cars. If anything, if your payment's great and you qualify, fantastic. But man, isn't it worth it to say, you know what? I don't have to have that fancy car for a little while. I'd rather have the house where I'm going to make a bunch of money and enjoy stuff from my family. And then once I get the house, then I'm going to go buy the fancy car, because at least now I've got a garage to put it in. So don't go make large purchases anytime before closing until you get the keys in your hand and they tell you it is funded and the house is yours. You do not buy anything. Okay. Number 7, applying for multiple loans simultaneously. Most people don't realize this is a big no-no in the mortgage industry, but it is. There's automated systems that we have to run that attach a number to you specifically. Like if it's a government loan or conventional or whatever it may be. Number 1, your lender can tell if you're applying with multiple lenders. Number 2, that number puts a hard stop from a mortgage perspective, that there's a certain point in time we could not move any further forward on your mortgage loan because that number may be attached to you by a different lender. You have to make a decision when you're going with a lender. You cannot play 2 people against them. Honestly, that's considered mortgage fraud too. If you say, you know what, I'm not applying for the mortgages, but I've got this other one going over here for an investment property, and I'm using you, Mr. Lender, for my owner-occupied property at the same time, you will be in a world of hurt when that gets figured out. Do not apply for multiple mortgages at the same time. Use the same lender, get it done, and then move on to the next one. Okay? Very, very important. Number 8, not having sufficient documentation. All right, look. As a lender, there's never a time I'm going to ask you for documents that we don't need. I'm not in this for fun, right? I'm not just going to set your paperwork on my desk and say, hey, I'm so excited that you provide me more paperwork. I really appreciate you sending it to me for no reason. That's a waste of my time and energy. It's a waste of your time and energy. We're only going to ask for the documents that we have to get your loan done or to answer questions about documents you provided. So for example, you pay off a car. We have to know, where did you get the money from? If you're like, well, I didn't want to tell you guys this, but I borrowed it from a buddy of mine. Well, now we have to verify all that. We have to list it as a gift. We have to get your buddy's income documentation to prove that he has the assets to give you that money. And that changes the way that your file is underwritten and you may no longer qualify. So it's really, really important that you are honest up front with the documentation, giving everything, telling the entire story. We're on your side to try to figure out a way to make your mortgage loan get taken care of. And it's kind of like if you go to the doctor and you don't tell him all the symptoms, there's no way he can properly treat you. Same thing on a mortgage side. We can't properly depict and put together your mortgage until we know all that documentation and details. So make sure you tell us up front and fully document it all. Number 9, switching bank accounts or moving money around. All right. It is not as simple as transferring money back and forth and you can have money anywhere you want. I've got this cash under my mattress situation. That makes it extremely difficult to get a mortgage loan. Number 1, you cannot document cash as a down payment or closing costs in any way, form, or fashion. And that happened from September the 11th. Back in 2001, it's called the Patriot Act disclosure. And that is a federal law. We have to document where every bit of your cash comes from. So if you say, hey, Steve, here's a picture of $20,000 I'm going to put down, that will not work. It must be in a bank account, and it must be in a bank account seasoned, which means it must be there for a minimum of 60 days. So you can't just have money going around. Moving money between accounts. We see that documentation on a bank account. So if you move money from this magical account that I don't know anything about to your current account, it shows, hey, this money was transferred from this account number. And now we have to ask for that bank account information as well. It just creates a paperwork nightmare. So let's keep it clean and consistent. You guys are going to like the lender much more, and it's going to make our job a lot easier to get you across that finish line and get you into home. So don't change bank accounts. Don't close a bank account and open another one. Don't move a bunch of money around unless you have to, and we've had this conversation. All right. The last one, but definitely not the least one, is understanding or underestimating closing costs. Listen, when you're getting a mortgage loan, there's 2 sets of closing costs: down payment, closing costs. They're not interchangeable. These are 2 separate things that you have to pay. Now, if you've got a 100% financing loan, that takes care of your down payment. Okay. But you still have closing costs. So closing costs are like setting up your escrow account, which is the account that your taxes and insurance and everything sit in for your home. Could be like the cost of an appraisal. Could be the title company and their fees that they're going to charge no matter what. You have lender fees. You have a credit report cost. There may be a survey. There's all these other fees that will exist on a mortgage loan that it's important for you guys to understand that those things are there. And if you don't save the money or have a situation where the seller is paying that on your behalf, then you're not going to be buying a home. And I don't want you guys to fall for that. I want you guys to have a great solution here. Those closing costs can be anywhere between 2 and 5% of whatever that purchase price is on the home. So closing costs are different from down payment. It's important to know those things. Listen, that's the top 10 things that you guys need to know about. If you stay on track and you listen to what I just told you with all 10 of those pieces, you're going to be in great shape to buy a home. We're going to have a lot of fun getting it done. It's going to be smooth and seamless. You're going to love it. You're going to enjoy your new home, spend Christmas and Thanksgiving and birthdays all there. But if you start messing with those 10 things, it's going to be a mess. So, all right, guys, I appreciate you. Hope you have an awesome day, and we'll talk soon. All right, bye-bye.